Hi, I'm Tracy Sofra and welcome to the Women of Wealth podcast. Today, I'm going to lift the lid on residential investment property once and for all. Why? Because I keep hearing about how that is the best way to retire, and it's set up your retirement nest egg by having multiple investment properties, and there seems to be a lack of information when it comes to investment properties, where they fit into building wealth, and basically the asset class of residential investment property is highly misunderstood. But the biggest part that really is misunderstood is that most people are led to believe that it is a great vehicle to retire on, and I'm about to lift the lid on that. So let's jump in and let's talk about residential investment property. Okay, so I have been advising on property for the last 34 years, multiple types of property. You know, there is commercial, there's industrial, and, there are REITs, which are real estate investment trusts. But predominantly, most people have a love affair with residential investment property. So I'm talking about residential when I'm speaking on this particular episode of this podcast. I also have invested in a multitude of residential investment property and still hold a few of those. Primarily, I invest in commercial property. So in today's podcast, I want to talk about what it means to invest in residential investment property, why you should invest, and what you should do once you retire with those properties. So let me jump straight in first and foremost by just telling you, giving some figures. Property growth over the last 10 years. Let's look at capital cities, right? Over the last 10 years, Sydney has done 7% per annum growth rate over the last 10 years. Melbourne's done 4.3. Brisbane's done 14.1. Adelaide's done 15.4. And Perth has done 18.5. That is over the last 10 years. And you can see that property itself, Melbourne being a little bit low over that period of time, but total... that's the per annum growth, but total 10-year growth. So let me give you some clarification there. The total 10-year growth over that period of time is the 7, the 4.3, the 14.1, 15.4 and 18.5. So you can see that residential investment property is a very, very strong asset that can create growth over a long period of time. And typically we look at 10 years for property itself. Let me talk about the advantages of why you would go into property. It is by far, if we're looking at asset classes or types of assets, what are they? Generally speaking, it's property, it's shares, it's fixed interest, and it's cash. They're the four main types of asset classes. Why is property so powerful? Property has the ability to double in 10 years. Generally, we say it is a long-term investment hold. What does that mean? 7 to 10, probably 12 years on average as a good holding period, and it does double over that period of time. Property itself gives you two things. It gives you capital growth. What does that mean? You buy it for $650 today, you sell it for 1.2 in 10 years. That's what we call capital growth. Okay, cash in the bank can't do that. At the same time, it gives you an income return. What is that? It's the rental returns that you get over that period of time of holding that property. So it has the ability to do both of those things. It's bricks and mortar. Everyone loves it, right? You can go and see it. It's tangible. It's a feel-good asset versus, and I'm not saying this to bag it out. I love shares. I invest in shares. They're powerful. They're simple. That's a topic for another podcast. But right here, right now, people get very nervous on the stock exchange and investing in shares. They feel way more comfortable investing a large sum of money into property because they can see it, they can feel it, it's tangible, and there's no index that they watch on the nightly news that goes up and down telling them, what property is done that day, whether it's gone down 2% or gone up 4% like the stock market does. So it doesn't create that sort of hysteria either. You can use property or you can use the equity in property once you get a couple of years up your sleeve and the value of that grows. And if you've managed to smash that debt down as much as you can, The difference is the equity in that property, and you can use that equity to get into another property or into other things. So it has the ability to provide that sort of security and equity for you to leverage off. It has a leveraging ability. It's a great inflation hedge. So inflation is the value of money over time erodes. Keeping money in the bank is definitely not an inflation hedge, but investing in property is a great inflation hedge because of the capital growth capabilities. And let's talk tax. If it is a negatively geared property, I have seen clients that have, and again, this is very dependent on your income level, whether you're a high income earner, it depends on the price point of the property you've purchased, it depends on how you've structured the loans, but have, I can say in general, very large sums of tax refunds as a result of owning investment property. Particularly high income earners can reduce the amount of tax that they're already paying on their income by having an investment property, and that investment property helps them claim some of that tax back. So at the same time, it's a win-win. They're claiming tax back of paying too much tax being on a high income, and they're invested in a growth asset that's growing over time that their future self will thank them for when that property becomes worth a lot more over a 7, 10, 12-year period of time. So there's some great advantages of owning real estate investment properties. What are some of the disadvantages that I really need to talk about? And I'm just highlighting these before I get into the real crux of what I really want to communicate here. First disadvantage is it's an illiquid asset, okay? It's not like having money in the bank or shares. You can't grab it within a 24-hour period. It is an illiquid asset. By the time you put it on the market and sell, it could be months and months down the track. There is a high cost of entry and a high cost of exit. So actually getting into the property market can be very, very costly. So you want to be really careful and making sure that you're making the right decision, because it's not like buying a jumper and saying, I don't like the colour anymore, I'm going to chuck it aside and not wear that. Cost of entry is typically stamp duty, depending on the state that you're in, plus conveyancing. Generally, they're the two biggest costs. And on exit, when you sell, you've got to pay agents' comms. They vary depending on the agent, can vary from 2.2 to 3.3, which can be quite high if you multiply that out over hundreds of thousands of dollars. And you've also got the conveyancing as well. Property, residential investment property typically has a low yield. Now, the yield word is return on investment, or if I could put it this way, what's the interest you get on a term deposit? What's the yield that you're getting on a rental property? So the yield is how much are you earning on that? Typically, we look at it from a gross point of view. Gross point of view means just the rent, not the expenses. So if you just take the amount of rent that you're receiving and you divide it into what you think the value of that property is, it'll give you what we call a rate of return. Is it 4%? Is it 5%? Is it 3%? Generally speaking, it is a low yield, most, and I'm generalizing, and it's generally around, it could be 4.7, 4.5%. By the time you take all the costs of running that property, you're probably getting a 2% return, which isn't even keeping up with inflation. So typically the yield is really low. So you might now be begging the question, why are we investing in this again, Trace? Because it has capital growth, remember? So it has the ability to be worth more over a 10-year time frame. During that time frame that we've got this property, it may not have a high yield, but it will also provide us with tax benefits. And so during the course of our working life, it makes a lot of sense. What I'm about to share with you doesn't make sense in retirement. Also, one of the other disadvantages is the management of properties. You could have tenancy issues, you could have vacancy issues, all of those sorts of things. But you know what? Just a little side note, that's what you get landlord insurance for. See, when you get into property, you get landlord insurance that covers you for malicious damage, loss of rent, all of those sorts of things. But, not everyone loves this sort of stuff and not everyone deals with it in the same way. So it can be a bit of a headache for most. Also, it can be quite costly if negatively geared. So whilst negative gearing provides tax benefits, sometimes if it's negatively geared, which basically means that the expenses outweigh the income, which is the rent. You've got to be in a position to be able to hold that property. So is it going to cost you 100, maybe 150 a week to hold that property? That will depend on how negatively geared it is, and that could be one of the disadvantages, that you're going to have to use your funds to prop up this property as you go along. Having said that, so now you should have some sort of an idea of the benefits, the disadvantages, the advantages, and get some sort of an understanding of where we're at with investment property. And I hope I've been able to explain that having an investment property throughout your working life can be incredibly powerful, and a very powerful way of creating wealth, because getting into a property at, again, as I say, at 650 price point, selling it in 10 years for 1.2, you can't save that sort of money. You've got to make that sort of money. You've got to create that sort of money, and you do that through using an asset such as a residential investment property. But here's the fallacy. Most people think that building wealth through a real estate portfolio is the way to go. They're talked into thinking about real estate is how they should retire. Retire on 5 to 10 properties, they say. I just want you to stop and take a breath and listen to what I'm about to say. Real estate returns are really low. So imagine that property that you've just bought throughout your working life, and you want to retire on that. First and foremost, you need to have paid out the loan. If you haven't, then that's still a major cash flow drainer on that property. But in retirement, what happens in retirement that what don't we have in retirement, I guess, is our ability to earn an income. If we stop and we retire, we don't earn an income anymore. Therefore, we're relying on all the assets we've built up to put money back into our pocket. If all of our assets are in residential investment properties, and as I mentioned before, the yield is really low, what do you think your income in retirement's going to look like? You're going to be what we call asset rich, cash flow poor. Asset rich meaning great portfolio, great value sitting there in multiple properties from a value point of view, but that value is only returning you, if you're lucky, 3%, maybe 4% in retirement. I would argue that that's not the way to retire, and I see this over and over again. So what I want to talk about is, I probably jumped ahead of myself, but what I want to talk about is that clear distinction of an investment property is an incredible leverage vehicle that will help you catapult you to another level of creating wealth. But at the time that you retire, what you want to be doing is you want to be considering what to do with that property and where to go from there when you go into retirement. So retiring on a multitude of properties is not going to provide the return that you need to be able to live. If you take the value of all those properties that you've built up, let's say you've got a portfolio of 4 properties, and again, they're only going to be yielding you, if you're lucky, probably 3 to 4%. If you had that capital, those 3 to 4 properties, say they were all about 650 and they got to the 1.2, you're going to have $4.8 million worth of assets producing you maybe 4%. Imagine if you had 4.8 worth of assets producing 6, 7, 8%, just about double that. How would that change your life, and what would retirement then look like? And you wouldn't have any of the tenancy issues. You wouldn't have to lodge a tax return anymore, because whilst you've got those properties, you have to continue lodging tax returns. You have to manage the rental on those properties, even though you get a real estate agent to do that. But at the end of the day, rents go up and down. You need an asset manager to do that. You've got tenancy issues and the like. So I'm hoping that this has kind of made you think, oh my God, I never thought of it that way. No one really explained it in that way. That's why I say you need to diversify. Simply using property as the only way to prepare for retirement is not the only way to go. It's a very powerful asset given. If you can do it, you should definitely look at it. But retiring on residential investment properties and nothing else will not provide the type of income that you require to live a comfortable lifestyle in retirement. So at Wow Women, what we do is we use what I call the foundational trinity to invest. We diversify, which is the exact method that I created and I use myself because it's a simple way to get invested. Okay. If you need help crafting an investment plan that works for you, then click the link in the description and you can book a call with one of our strategists and they're going to show you how exactly the foundational trinity works, and you can get started on your journey of building your retirement nest egg and building it right. Best of all, the call is for free. Make sure to subscribe to our podcast on your favourite podcast platform, and make sure to check out all of our other episodes that may be of interest to you. Thank you for joining me.